The next time you're cruising down the highway, maybe you're running late for work and you pass one of those massive 18-wheelers, I really want you to think about something.
Yeah, because usually we just see a truck delivering, those online orders we clicked on a few days ago.
Right, exactly. But beneath the surface, there's this massive, entirely invisible, and honestly highly controversial safety net holding that entire logistical system together.
It really is invisible. I mean, to anyone outside the logistics sector, we just expect our shelves to be stocked.
Yeah, totally.
We expect supply chains to run flawlessly. We rarely think about the physical and, frankly, the financial scaffolding required to keep those wheels turning, especially when things go wrong.
And that scaffolding is our mission today. We are doing a deep dive into a really fascinating stack of source material today. We've got recent industry reports, 2025 and 2026 carrier updates, and some truly wild legal
A
analyses.
lot of ground to cover.
It is. We want to explore occupational accident coverage, or OAC. Basically, we're going to unpack what actually happens when the people moving our entire economy get hurt, and why the legal definition of their job is the single hottest topic in the freight industry right now. Okay, let's unpack this. Where do we even begin to understand the mechanics of this safety net?
Well, I mean, we really have to start with the sheer scale of the independent contractor model. Our 2025 and 2026 data shows an estimated 922,854 independent owner-operators currently on U.S. roads.
Wow, so nearly a million people.
Exactly, almost a million. And as anyone following the industry knows, the friction here stems from statutory labor laws.
Right, because traditional workers' comp has, strict rules, right?
Yeah. Traditional workers' compensation is a statutory requirement, but it generally only applies to W-2 employees. And because these nearly 1 million drivers are classified as independent businesses, they sit entirely outside that statutory framework.
Which creates just an enormous vulnerability. I mean, if you're an independent contractor, you're essentially an island.
You really are.
If you get hurt on the road, whether you're driving, loading cargo, or just slipping at a fuel island, you might have absolutely zero workers' comp protection.
Zero. Nothing to fall back on automatically.
And in trucking, if you can't physically operate the machinery, your revenue stream doesn't just, slow down, it stops on a dime.
It's immediate.
Right. So you combine zero incoming revenue with the immediate medical costs of a serious injury, and a driver's financial life can evaporate in a matter of weeks.
And that vulnerability is the exact reason occupational accident coverage was engineered in the first place.
As a workaround.
Exactly. OAC is essentially the logistics industry's custom-built workaround to bridge that massive protection gap. It's a specialized insurance policy designed specifically for independent contractors, lease operators, and owner-operators who are otherwise totally exposed.
I kind of want to visualize how this risk transfer mechanism actually works because it operates very differently than statutory coverage.
It's fundamentally different, yeah.
So is it fair to say workers' comp is like an all-inclusive resort where everything is covered automatically, but OAC is more like an a la carte menu? It's cheaper and more flexible, but you have strict limits on what you can order.
What's fascinating here is how that a la carte structure serves as a strategic firewall for the motor carriers.
Oh, interesting. How so?
Well, think about it from a liability perspective. A carrier relies on independent contractors to keep capital costs down, right? And to maintain flexibility.
Sure, yeah.
But if an uninsured contractor gets catastrophically injured while hauling the carrier's freight, the carrier is highly vulnerable to a lawsuit. So by offering, or often outright requiring, an OAC policy before a driver can even be onboarded, the carrier builds a firewall.
Ah, I see.
Yeah, they ensure the driver has a dedicated pool of money to draw from if they get hurt, which dramatically reduces the incentive and the legal grounds for that driver to sue the carrier or, file a misclassification claim.
Right, basically caps the exposure for the company. But let's look at the other side of that firewall, the driver's side. The sources mention several reasons why drivers actively purchase OAC. Income protection is obviously huge.
Huge, yeah. But it's also often a strict contract requirement just to get the job in the first place.
Right. And they also buy it to shield themselves from crippling medical debt and for the accidental death and dismemberment benefits.
The AD&D, exactly.
Yeah, which provides a payout to their families if the absolute worst happens. But wait, couldn't they just buy a regular commercial policy on their own?
Well, the speed of deployment is another massive mechanical advantage for the driver with OAC. Securing a standalone workers' comp policy as a single truck business can be notoriously slow.
Oh, I bet. red tape and all that.
Yeah, it's expensive and bureaucratically heavy. OAC programs, on the other hand, are often sponsored by the motor carriers themselves.
So it's just faster.
Much faster. A driver can enroll, get the premiums deducted directly from their weekly settlement checks, and be legally compliant and out on the road in a fraction of the time.
That makes sense. But since it is an a la carte menu, I want to lift the hood on these policies. What actually happens when the firewall is tested? The injury scenarios detailed in our sources are incredibly grueling.
Oh, they're brutal.
Yeah, we aren't just talking about a fender bender on the interstate. The physics of this job are just, well, they're intense.
The physical toll is immense, and the mechanics of these injuries really explain why the coverage has to be so specific. I mean, you have the obvious high-speed highway collisions, but the claims data reveals a much broader spectrum of trauma.
Like, whoa, what else are we seeing?
Well, consider the mechanics of trailer coupling. A driver isn't just hooking up a little wagon.
Right, no.
They're manipulating a 500-pound fifth wheel mechanism, connecting pressurized air lines, and dealing with heavy, greasy metal that can easily pinch, crush, or snap back under tension.
The reports also specifically highlight icy yard falls, which sounds simple, but navigating a frozen, poorly lit freight yard in the middle of winter while trying to inspect an 80,000-pound vehicle, I mean, that's a recipe for devastating orthopedic injuries.
Oh, absolutely.
And there are severe loading dock incidents, accidents while trying to winch down and secure heavy cargo on flatbeds, and frankly, the cumulative slow-motion trauma of repetitive strain.
Yeah, from vibrating in a cab for 11 hours a day, it takes a huge toll.
Exactly. So when one of those accidents occurs, the driver relies on specific buckets of funding within their OAC policy.
Right. And the core of this is the medical expense coverage, which pays for the emergency care, the surgeries, hospitalization, and diagnostic imaging.
And what are the numbers like for that?
Well, the typical limits we see in the text range from $250,000 up to $1 million.
Okay, I'm going to stop you right there and push back on that a bit.
Yeah.
$1 million in medical coverage sounds like a ton of money. But if a driver suffers paralysis or a severe highway collision, does that actually go as far as it used to?
That's the million-dollar question, isn't it?
I mean, a month in the ICU, multiple spinal surgeries, long-term rehab. Couldn't you burn through that cap before the driver even leaves the hospital?
You definitely could today. Historically, underwriters would argue that $1 million was perfectly adequate.
Really? Just $1 million?
Yeah. For over a decade, keeping the limit at $1 million struck a very deliberate balance. It covered about 99% of standard trucking injuries. You know, the broken legs, the torn rotator cuffs.
Okay, that makes sense.
And it kept the monthly premium low enough that an owner-operator running on razor-thin profit margins could actually afford to buy it. Yeah. If carriers had pushed the mandatory limit to $3 or $5 million, the reinsurance costs would have spiked.
And the premiums would have doubled, I'm guessing?
Exactly. And drivers simply would have opted out or left the industry entirely.
But the math on that historical balance has fundamentally broken down recently, hasn't it?
Completely. And that is the exact crisis our sources highlight regarding the 2025 and 2026 data.
Right.
The insurance market hit a breaking point where those stagnant limits were colliding with runaway medical inflation. $1 million simply didn't buy the same amount of healthcare it did 10 years ago.
Which brings us to the massive market correction led by Zurich North America. They looked at the data and realized the firewall was becoming entirely too thin to protect anyone.
Yeah, Zurich initiated a sweeping overhaul of their underwriting in late 2025, setting a totally new benchmark for 2026. The financial mechanics of this correction are staggering, honestly.
Let's hear the numbers. What did they do?
They rolled out up to a 50% increase in the combined single program limit and the medical benefits.
Let's break down that jargon for a second. The combined single program limit. How does that actually function for an injured driver?
So instead of having rigidly siloed buckets of money, say, a strict cap on medical bills, a separate strict cap on rehab, and a separate cap on disability, the combined single program limit creates one massive overarching pool of funds.
Oh, that's way more flexible.
It is. The driver can draw down on that single pool however their specific emergency dictates. If they need more money allocated to surgeries and less to rehab, the flexibility is there, up to the new, significantly higher cap.
And the sources also mentioned they increased the temporary total disability and continuous total disability limits by up to 60%.
Yes, and this is the income replacement mechanism. If a driver cannot work, temporary total disability pays out a percentage of their average weekly earnings, usually after a 7 to 14-day waiting period.
It keeps the lights on at home.
Exactly.
Right.
By bumping those caps up by 60%, insurers are fundamentally changing a driver's ability to keep their household afloat while spending months in physical therapy.
The sources quote Mike Saporito, he's the head of occupational accident at Zurich, and his assessment of the inflation crisis is pretty stark. He says, quote, across the insurance industry, occupational accident benefit levels for independent truckers weren't keeping pace with economic realities. The purchasing power of 1 million benefit today is only about 700,000 compared to 2009.
Yeah, a loss of $300,000 in purchasing power is just catastrophic in a medical emergency.
It's massive.
It is the literal difference between a driver recovering and returning to their livelihood or losing their truck to the bank and declaring personal bankruptcy.
And didn't Zurich add some new ancillary benefits too?
They did, to plug the smaller but equally devastating financial leaks. They improved coverage for ambulance services, dental trauma, mental health expenses, and crucially, they added benefits to cover the driver's truck payment obligations.
Because the bank holding the note on that $150,000 rig doesn't care if the driver's in a hospital bed.
No, they absolutely do not. They expect their monthly payment.
Here's where it gets really interesting, though. When you look at these massive upgrades, the 50% bumps, the truck payment coverage, the mental health benefits, the source material makes it clear that these A-rated admitted carriers aren't just upgrading the policies out of the goodness of their hearts.
They're only not just altruism, no.
Right. The mechanics of the trucking labor market have shifted. Motor carriers are now using these robust premium OAC plans as a major competitive tool. It's no longer just a liability firewall. It has morphed into a retention strategy to keep reliable drivers in the seats.
It's a remarkable evolution of the product, really. The carriers are essentially subsidizing better safety nets because the cost of recruiting a new reliable owner-operator is vastly more expensive than chipping in for a better OAC policy to keep their current fleet happy.
That makes total business sense.
It does. And some of these premium programs, particularly in the Canadian logistics market, are even offering what is called 24-hour coverage.
Wait, what does that mean?
It broadens the scope significantly. It actually covers the driver for injuries that happen off the clock, blurring the line between a strict occupational policy and a comprehensive general health plan.
Oh, wow. And on paper, this sounds like an incredible win for everyone. The coverage limits are finally matching inflation, the carriers are actively competing to offer better safety nets, and the drivers are getting more comprehensive protection.
It sounds ideal.
Right. So why is this specific insurance product still the subject of such intense controversy and labor backlash?
Well, we have to look impartially at the legal and labor criticisms detailed in the sources, because this backlash threatens the foundational structure of gig logistics.
Right. What are the critics saying?
The primary argument from labor advocates is that OAC, by its very design, shifts the ultimate burden of risk away from the corporation and onto the individual worker.
Because even with the upgrades, an OAC policy is still governed by contract law, not statutory labor law.
Exactly. With traditional workers' comp, you have guarantees backed by the state. If your employer's insurance denies a claim, there's a formalized state-run appeals board you can go to.
But OAC doesn't have that.
Critics argue that OAC lacks those statutory legal safeguards entirely. They point to inconsistent claims handling and much narrower definitions of what actually constitutes a, quote, covered injury.
So if a claim gets denied?
If an OAC claim is denied, the independent contractor doesn't have a state labor board in their corner. They are forced to fight an insurance conglomerate through private arbitration.
Which requires money and time.
Resources a sideline truck driver simply does not possess.
The deep dive into the online worker forums in our source material really illuminated this friction. You read through these industry message boards, and they are just filled with drivers detailing denied claims, intense confusion over the fine print of their eligibility, and just a profound frustration with the claims process.
Yeah, it's a huge pain point.
They feel like they're paying into a system that looks for loopholes to avoid paying out when a true catastrophe hits.
And those disputes over claims and eligibility invariably lead back to the ultimate legal minefield in the freight sector today.
Yeah.
The contractor versus employee misclassification problem.
This is the paradox that makes this whole system so fragile, right?
It really is.
The irony of the 2026 landscape is that by offering better, more comprehensive OAC benefits to retain drivers, acting more like an employer who cares for an employee motor carriers, might actually be increasing their risk of a misclassification lawsuit.
Because they're making independent contractors look more and more like traditional employees.
Exactly. So if a driver walks like an independent contractor, but the carrier controls their route, their schedule, and their truck's branding like an employee, a piece of paper saying independent contractor might not hold up in court.
This raises an important question, and it's the exact tension regulators are zeroing in on. Courts and labor boards are no longer accepting a signed piece of paper at face value.
They want to see how it actually works day to day.
Right. They are looking past the contract and scrutinizing the operational reality of the relationship. They want to know the mechanics of control.
So what specific mechanics are the courts looking at to determine if a driver is secretly an employee?
They examine route control like, does the driver actually have the freedom to choose how they get from point A to point B? They look at exclusivity requirements.
Meaning, can they work for other companies?
Exactly. Is the driver legally allowed to haul freight for competing companies, or are they captive to one carrier? And they heavily scrutinize the compensation structure and equipment ownership.
The sources specifically mention truck branding as a major factor, which makes a lot of sense when you think about it.
It's a very visible form of control.
Right. If a carrier forces an independent driver to wrap their personal rig in the carrier's corporate logo, the court views that as the carrier extracting brand value while forbidding the driver from advertising their own independent business.
It's a clear mechanism of control. And the sources note that this level of regulatory scrutiny has just skyrocketed with the massive growth of gig logistics, app-based freight platforms, and complex lease purchase driver programs.
So what happens when a court looks at all those factors? The branding, the route control, the comprehensive OAC benefits, and decides that the motor carrier has crossed the line.
Well, if a judge rules that these drivers were actually statutory employees all along, the OAC firewall instantly evaporates.
Because OAC is legally insufficient for an employee.
Exactly. The motor carrier is suddenly exposed to massive retroactive lawsuits for failing to provide actual workers' compensation, completely bypassing the limits of the OAC policy they relied on.
Wow.
Add in the penalties for labor law violations, unpaid overtime and back taxes, and a single misclassification ruling can bankrupt a logistics company overnight.
That is just a massive existential threat hanging over the supply chain. Occupational accident coverage has really evolved from a niche, bare-bones product for a small subset of owner-operators into a central, load-bearing pillar of modern risk management.
It has. The entire economic model of flexible, gig-based trucking basically rests on this insurance holding up in court.
So what does this all mean? Well, for you, the listener, it means that the incredible speed and convenience of the modern economy, the fact that you can click a button and have building materials, fresh produce, or electronics delivered to your local store in a matter of hours, is not just a triumph of engineering.
Not at all.
It relies entirely on an incredibly delicate, highly controversial legal balancing act between contractor classification and specialized insurance limits.
If we connect this to the bigger picture, almost every single physical item around you right now was brought there by a driver who was physically navigating that specific legal and physical risk.
It's pretty wild to think about.
It is. The integrity of that invisible safety net literally dictates the cost and availability of everything we consume.
It is a completely hidden infrastructure of risk and liability that most of us never see. And it leaves us with this to think about. If the legal line between independent contractor and employee completely dissolves in the coming years, will the entire gig-based freight system that delivers our daily goods be forced to fundamentally reinvent itself? Next time you see a truck on the highway, ask yourself, who's really in the driver's seat of that business?